So welcome back, guys. This is Mina. This is the second episode in our investing series. In this video, we're going to talk about stocks. So last video, we talked about what is investing, why we should invest, and where are the asset classes that we can invest in. I really recommend you take a look at that video somewhere up here. Let's just dive right into this one and take a generalized look on what is a stock and how can I make money off it. So let's just get one thing right out of the way. We are now talking about investing, not gambling. So I know we've all heard the stories. This guy bought a stock for $1 and it's now $1 million. Okay, this is not the story we're going to be talking about. This does happen, yes. It's a very, very small percentage, and I probably think I could safely assume it's not going to happen to me or you. So let's just talk about the things that we can do and understand generally what a stock is. Do not look for hot tips or buy this stock now to the quadruple its price in 2 weeks. None of that is what we're talking about. So let's just dive right into what it is. So a stock is nothing more, nothing less than ownership in a business or a company. So you buy Amazon stock, you own a part of Amazon as a business. So what does that get you? That gets you ownership in the company. It gets you, you are now entitled to their profits. And in some companies, you may get voting rights. We'll talk about these in the future. But generally, however much outstanding stock there is, so let's just give a random number here. If there is 100,000 shares on the market and you buy one, so you own 1/100,000th of Amazon. That is all a stock is. So that is what is a stock. Now, why would I buy a stock? Like, how am I going to make money from this? Is this just an arbitrary piece of paper or whatever? No. So, as we said, you own the company now, or you own part of it, so you're a business owner. Generally, how a business works is they have a product or a service which they sell and earn some money here, right? They have earnings. From these earnings, they have some expenses. They have to pay their CEOs, they have to buy, they have to rent, they have a whole bunch of expenses, and then there is profit remaining. So this dollar is profit. Now you as a shareholder and an owner of that company, what happens with that dollar? Do you get it? Well, these are the two ways you can make money out of a stock. So there is something called dividends, which is basically a payout. So the company then decides, what are we going to do with this dollar? Some companies give it out as dividend or part of it. So they say, okay, so we have $1 million and we have 1 million shares, so each person gets $1 and you would get that dollar sent to you. Other companies would take this dollar amount and then reinvest it in the company because they're a growing company or they want to invest in their products, research, development, whatever that looks like. And that way they reinvest, they make hypothetically a better product or service, and then they get more money, so the stock grows. So that number one would be dividends. Number two would be appreciation. So you could either get money directly or the value of your stock has risen because of better business protocols, better services, whatever the case is, and the company's getting better in general. More people want to buy it, the price goes up. So these are the two ways you could make money off a stock. Okay, so now which stock do we buy to make money? All right, just relax, chill. We're just taking it easy. We're trying to understand this as a business and how to actually evaluate stocks and what are they. So there is no stock to buy and this one will make you $1 million. Let's just be clear here. The stock price fluctuates up and down every single day and every single minute. And that's just basically people negotiating with each other about the price of that stock. So what happens is we have an owner who owns an Amazon stock. He owns one Amazon stock. And then we have someone right here who wants to buy it. So there's something, it's called a broker, just like most markets. He connects these two people together, and then this guy is able to sell his stock to the buyer. The price is dependent on the supply and demand, just like any other market. And just like any other market, there is good news and bad news. So bad news will get the stock price tumbling down. Good news will have it rising up. So why is that? Let's go for an example. So good news, we heard that this company, let's call it Apple, are developing a completely new, different phone, and they're going to have this amazing new technology where you just teleport, whatever it is. So now everybody's happy. This seems like a company that's going to make money, so everybody rushes to buy it in hopes that they will get appreciation. Once that happens, everybody goes to buy. The supply is still the same, but the demand rises. Hence, the price rises. On the other end, there's bad news. You hear all of a sudden that this CEO is cheating, or if he's doing this, or he's doing illegal stuff, whatever the bad news is, even if it's rumors, but if people start listening to it and believing it and selling the stock because they feel the company will fail, then the price starts tumbling down. So that's essentially what happens with the stock market. That's why it's very volatile and it moves up and down, because it's just folks thinking what the company's worth. It's a negotiation all day, every day, and it basically depends on what the collective market thinks a certain company is worth. So, in conclusion, what do we get out of this? So what we have to know from the very beginning, we cannot be emotional. We need to understand fundamentals and understand how a company works, how it makes money. Do we see that this is going to continue on? Is this a viable product? Whatever that case is. So never ever invest in anything you don't understand because of these fluctuations. Fear, greed, just move the market rapidly up and down. We should not be swayed by any of these things. There is money to be made everywhere in all different scenarios, but right now we're talking about being investors, not gamblers. These are two different things. Okay, so in an effort to keep these videos relatively short, simple, and sweet so we don't get overwhelmed, that would be the conclusion of episode number 2. I really appreciate you guys sticking around till here. In the next video, we're going to be talking about bonds, and we're going to just keep banging out all these asset classes and then take it further from there. I promise you it's very easy to understand. If you have any questions, please reach out to me and I'll try and put more videos out to explain certain things that people are asking about. Thank you very much for watching all the way to the end. Please subscribe to the channel if you can. A little comment if you have certain ideas you want me to talk about in the future, and I'll try and pump out the next video as soon as possible so we can get through this quickly and start getting into the nitty-gritty details. Remember, be an investor, don't be a gambler. We are here to invest our money, take control of our financial futures. Stay happy, stay healthy. We'll see you in the next one.